Hi, this is Kirk Davis, Executive Director of Camps. It's a pleasure to be with all of you here today. We have a very exciting panel, and I'm going to take just a moment and introduce them. And I'm not going to do it justice because in the interest of time, it would take longer to introduce them with their extensive backgrounds and accomplishments. But Shirish, if you'll raise your hand so they know who you are. Shirish, thank you for joining us. He is the founder and managing partner of Amg Partners. They're a permanent capital investment firm focused exclusively on the advanced manufacturing sector, which makes your presence here very exciting. And then Shirish has a very big background. I was reading about the company you started. Shirish, what was the name of the company that you started?
Hydraulics Global.
Yeah. That you've experienced exciting growth in that company, and you serve on the board of the Carnegie Museum of Art and several other very impressive boards. You're on the Leadership Council of M Foresight, which talks about U.S. manufacturing competitiveness, and you served also under President Barack Obama and under the Commerce Secretary in the Workforce Council. You became the co-chair of the Workforce and Skills Subcommittee. And so you know something about the real life struggles of our manufacturing companies.
Of course, Davis, and pleasure to be here, and really looking forward to learning from the fellow panelists as well as participating in the discussion.
Well, thank you so much. And I appreciate you being here. Nabil, if you'll raise your hand so they know who you are. There he is. Nabil is he's with Celtic Capital, and they're providing asset-based financing. So you're going to hear more about that today. And they work with companies all over the United States. But Nabil's very interesting, coming from an attorney background. Is that right?
That's right.
And chief compliance and ethics officer for over 20 years. And then you, I don't know, you seems like you have a very strong healthcare background in addition to your finance background. So it's really wonderful to have you here. And we'll hear more from you in just a moment. And Kevin, if you'll raise your hand, there he is. Kevin is principal, he's of CFO Selections with like 30 years of experience in finance. And we were just talking before the call about your experience with Pacific Lighting and how with you on board, they grew from like 12 million to 70 million. A very exciting ride. And that brought you to CFO Selections. And CFO Selections specializes in bringing senior financial and accounting talent to your business. I like how on your website it says, we do one thing well.
That's right.
You guys do that very, very well.
Thank you.
And you've got a background in real estate and commercial lending as well. So in commercial or real estate investment. And Joe, if you'll raise your hand, or our panelist speaker. Joe has it's probably more than 16 years at JP Morgan Chase, and even more years than that in banking. But she's the executive director, and she manages relationships in the middle market companies of the Seattle area. She is also, and I've known her more on the board of Camps, and she's just been an excellent person and very creative and idea generating person on all of our committees. We've appreciated your participation there. So with that, I will go ahead and turn the time over to Shirish to give us 5 minutes about you and your company.
Again, Kirk, thank you so much, and really looking forward to the discussion. At Amg Partners, our focus is really investing in advanced manufacturing businesses. And when I say advanced manufacturing businesses, it's really two sides of the coin. So on one side, we are looking at companies that provide advanced manufacturing related technology, products, services, things that will drive the future of advanced manufacturing, products and services and technologies that companies who want to be in advanced manufacturing, who are looking for digital transformation, they would be using. These could be automation businesses, these could be product and technology businesses, Industry 4.0 software companies, systems integrators related to advanced manufacturing. So that's one kind of companies we are actively looking for. And on the other side, we are also firm believer in importance of manufacturing in US economy. And with that, we realize that several SMEs are not prepared what is going to come our way in next decade. And we can talk at length about what happened during the global outsourcing wave, where a lot of American SMEs could not keep up. And advanced manufacturing, we believe, is a double-edged sword. And we want to partner with the companies. We want to acquire either majority or partial acquisitions of companies where we would bring our unique expertise to transform that company, to truly transform the company inside out using the latest in advanced manufacturing tools and techniques, and create long-term, perennial, sustainable values in these companies. So to that extent, our ideal partners are, let's call, $50 to $200 million businesses in specialty manufacturing space, aerospace and defense manufacturing, medical devices manufacturing, specialty, where the owners of the company, they see the value of their company, they see what's possible, but they may not have the know-how, or they may not have the runway or the risk-taking capacity or appetite to really go through the transformation themselves. We have significant people both on our management team in Amg partnership, but also an extensive network of people who are expert in variety of advanced manufacturing technologies. One of our members is has background in a $60 billion automation business. We currently, one of our companies, for example, to give example of kind of companies we are invested in, it's a business in automation space, which has benefited extremely during COVID. Despite we've been able to solve a lot of national challenges, we are building equipment to producing COVID test kits, for example, automation machines for producing medical devices. So hopefully that gives you a sense of Amg Partners. Another big focus for us is skill building. So in the companies we acquire, from day one, we would be focusing on skill building. We believe American workers have been left behind in last 30 years. And to really, it's not an issue of technology at this point. There is plenty of technology in our country. It's the know-how at the level of management or ownership, but also the workers to really do the transformation that is needed if America needs to be competitive in manufacturing. Again, as I said earlier, we are looking for companies in 50 million to 250 million revenue space, where either the companies are already providing advanced manufacturing products and services, or where we believe on day one that there are 1 or 2, 3 things we could do to truly transform the business for long term.
Shirish, that is really a great description, and it's something for us to think about in terms of you're bringing not only money but capability to the manufacturing companies to kind of expand the possibilities. And when you talked about the workers being left behind, I think you really hit a strong nerve with us. So thank you for that, Kevin.
Another point I want to add is I'm currently on the National Institute of Advanced Manufacturing board. And the board is stacked with some amazing people. The CEO of Siemens is on the board with me, Chief Operating Officer of Rolls-Royce. And so with our extensive network, we have the capability and the know-how. And really, you hit it very well, Kirk. We are a different kind of private equity group. The days of purely financial engineering to extract the value out of companies to pay down the debt, those days are over. To truly create value in American manufacturing, you need to transform and create sustainable value beyond just spreadsheet financial engineering that we've done for 30 years in our country.
Oh, that's wonderful. No, thank you for that explanation. That was a great start. Kevin, go ahead.
Sure, happy to. Thanks. I was all out of order. I was all ready for Nabil, but I'll rally. I can jump in.
Thank you.
Thank you very much for having me today. I truly appreciate it. My name's Kevin Briscoe. I'm the managing partner at CPO Selections. We are an outsourced professional service provider that operates actually under two brands. CPO Selections is our senior financial executives. Think CFO and heavy controllers in that respect. We also have a brand called ASP that is our bookkeeping and accounting resources. So everything below that, our service offering into organizations that we focused on can span the spectrum of accounting and finance resource. We have two primary offices in the Pacific Northwest. We were originally founded in 2002 in the Puget Sound market, and then subsequently expanded about 8 years ago into the Portland market as well. Across the organization, we now have about 85 CFOs working in the outsource space, and have about 90 folks under the ASP brand that are working in a variety of different industries and verticals. Manufacturing has, from the very beginning, been a focus of our organization. Of those CFOs that I mentioned, at least 20 of them are focused in the manufacturing space. We have been CAMPS sponsors from the inception as well, too, as I think an illustration of our focus in this space as well. In particular, I think the way I differentiate CPO Selections from the rest of the speakers today is that we can work with your organization to assist in utilizing all of their services and to help you make better decisions and be more effective in your interactions with private equity sourcing, whether it's alternative lending, commercial banking. All of those things are certainly in the wheelhouse of a CFO, but the biggest distinction that we have as an organization is that we concentrate primarily on the small to mid-market space with an eye towards providing fractional resources into the clients that we serve. So as opposed to being purely a staffing firm, we bring that senior skill set in at a day a week or 2 days a week, something to the effect that we're sizing for the organization. So a little differently than Shirish, our primary focus is between 3 million and 35 million in revenue for that outsourced CFO space. Bookkeeping and accounting, as you might imagine, scales down and is relevant for all the way down to $500,000 a year potentially. Everybody's got to do bookkeeping at this point, and unless you're in that discipline, you probably don't love it. We can be a resource to you in that regard. What we really try to do, and this happens in a significant number of our engagements, is we are aligning the skill set that you need with a total component of time that you need in your organization. It's very, very common that we will do a joint effort with resources from our CPO Selections bench as well as from our ASP bench, so that we're aligning the skill level with the individual that's most suited to be doing that. So another way of thinking about that, you don't want your CFO spending most of their time doing bank reconciliations. They can do them, and our team will do them, but that's really not the price point you should be spending to get that kind of effort and work done. One of the things I did want to talk about that I think almost everybody on the call would have been relevant for, and it's a quick illustration of how we focus on assisting folks in the manufacturing space. Everybody worked through the PPP process last year. Whether you took the money and funding or not, you looked at it as part of your evaluation. It's a perfect example of how we assisted clients, and in particular in the manufacturing space, to think about whether or not they had a need. And interestingly, not every manufacturer did. Most of our client base did, I think, take some level of funding, but not every single one. And going through that evaluation process was something we were able to help folks out with. That said, ongoing, we've got all kinds of other ways we can help with finance and accounting. We'll leave some of that for later on in the conversation. So thanks again, Kirk, for having me.
No, Kevin, that was a great explanation. And so we're going to look forward to asking more questions, but I really like that you're helping businesses get their financial house in order, which was a prerequisite to getting the kind of funding that we're talking about. So thank you for that. Yeah, and out of order, but we're nonetheless important. Nabil.
Thank you, Kirk, and thank you all for inviting me to participate in this panel. I'm Nabil Istafanous. I'm with Celtic Capital. We are a national asset-based lender, been based out of LA, but I cover the Pacific Northwest for Celtic. That's Washington, Oregon, Idaho, and Montana. And during the pandemic, because it was easy, I now cover the Bay Area. So I think that I've expanded my territory during this last year. But in any event, we provide non-bank lending. So we support companies in the lower, the small to lower middle market space that don't want or can't qualify for traditional bank financing. And we provide it based on their assets. So we'll provide lines of credit, for example, secured by accounts receivable and inventory, or we'll do equipment loans, either in conjunction with a line, or we do standalone equipment loans, which is actually fairly unique in the ABL space. Our facilities are from $500,000 to $5 million. So that roughly translates typically, at least for a line of credit, for example, companies that are in the 3 to 5 million at the low end, typically around 5 in annual revenue, up to 50 million in annual revenue. That said, when we do a standalone equipment loan, in fact, I spoke just yesterday with a company, really exciting, fast-growing company that is private equity backed. They've used only equity capital because they do not qualify for bank financing. They've used equity capital for all their working capital needs, including all their equipment. I'll be putting together a proposal for them for cashing out and refinancing their equipment so they can get a $5 or $6 million loan. But this company is going from, they expect from 100 million in annual revenues this year to 400 million next year. So you can imagine they would outstrip any bank facility until they sort of stabilize at the level that they want. We do a variety of things. Our customers are our clients, especially I'll mention in the manufacturing space. I just mentioned an example of a high growth company, but we also do a lot of turnaround. So companies in transition for whatever reason have to exit their bank relationship. They may have an existing bank relationship that they've tripped covenants on, whether that's because of what we just went through, frankly, right? The pandemic, many companies, their revenues went down, especially in the manufacturing space, very hard for them to cut their overhead costs. And as a result, no longer profitable and therefore tripping covenants. And I've gotten several inquiries in the last, I would say now, month and a half. Last year was a little quiet because of all those PPP loans that Kevin alluded to. But this year now banks are talking to their clients who are still struggling. Example of a client we've proposed on last week is also a manufacturer. They make custom fixtures and products for large retailers. So you can imagine, of course, their business took a tremendous hit last year. They did, get the benefit of PPP loans, both round 1 and round 2. For those of you, I'm sure everybody who's either represented manufacturers or manufacturers themselves know all about those PPP loans. But in any case, while those government grants were really great to help their balance sheet, it certainly didn't do much for their income statement, or at least their operating earnings. And so their bank did tell them that they're going to have to find another lender, and hence the referral to me. So that's also another example of how companies use us. We'd be able to provide them an AR and inventory and equipment loan. We will, unfortunately, their assets do not pay off entirely the bank liability. And so this is a great example of how we have to be creative, and we are working with them and counseling them. Actually, they hadn't taken advantage of those idle loans, those emergency loans. So what we want to do is we would come in first, pay off as much of the bank liability as we can, and then the company could apply for, and so the bank would sit back and have basically a lien interest in the company's assets behind us temporarily, while the company then applies for an idle loan. So that way we'd be first on the assets we're financing. Hopefully the SBA would be providing an idle loan, emergency loan behind us, and the bank would be completely paid off. So the bank, so the bank gets what they need. The borrower gets the funds they need, and we take care of the client. So that's another example of how clients use us, and it would be temporary until their business does in fact recover again, and no longer trips covenants. They have the 3-4 quarters of good performance that banks will typically need and want, and they'll be bankable, and at that point they take us out. And so that's how we usually operate, and that's a success story.
Yeah.
So that's me.
Great.
And hopefully I didn't take too much time, but happy to be here. Thanks for inviting me.
Well, Nabil, I think those are really great and timely examples. I mean, you're really talking about real world things that are happening right now. And so I think the questioning will bring out even more. So thank you. Yeah. Joe?
Good morning, everyone. Nice to see you. Thanks for joining us. My name is Joe VanDerSnick, and I'm a commercial banker with Chase. I've been with Chase for 16 years. I've been in commercial banking for about 30 years. On the board of Camps, so enjoy working with Kirk and his team. And in my day job, I work with middle market companies, and I partner with our business banking team for those smaller business clients to provide traditional banking services. So we are what you might think of as a cash flow lender. So we're looking at the company cash flow as the primary source to repay the debt. We're looking at collateral coverage, but we don't think of ourselves as an asset-based lender, who can go pretty skinny on debt service coverage, because there are excessive assets out there to draw on and potentially liquidate. So some of the things that we're seeing would be, as companies have come through COVID, working with them to understand, we're seeing a lot of companies that performed just fine through COVID, and they were stable. And with the economy bouncing back as it is, they're wanting to expand. They're wanting to expand their plant, their warehouse space. Many of them are expanding with equipment acquisition, but then also inventory. As they're looking to build, they need to raise their working capital lines to be able to support the growth that they're seeing today and what they're expecting to come this year. So we do traditional working capital lines of credit, equipment finance, owner-occupied real estate, and all the supporting ancillary services that go along with that.
Joe, it's really nice to have somebody that does traditional banking here. So everything else has been pretty untraditional. And so you represent, I think, and to me, bank money is the cheapest money out there. It's the best money for businesses out there. And so I think that becoming bankable, and that's maybe in Kevin's realm, but I think for manufacturing companies to become bankable, and then sometimes we need services like Nabil's to help, bridge the gap and do some creative things, especially in times of growth or crisis like we've been through with the pandemic. Joe, thank you for that introduction. And let's go ahead and open this up for questions. And so I have questions if other people don't, and you're welcome to come off of mute and share your question, or you could type them into the chat and we'll bring up the questions. So first of all, if I could go back to Kevin for a moment and talk about, from your point of view, what's kind of your advice to help manufacturing businesses become bankable, and reach that level of bankability? I know there's some, the 5 C's of credit or 4 C's of credit, and there's, some ratios that maybe you look at, but do you have any advice for helping us get more bankable?
Sure. interestingly, that's a wide-ranging question with lots of different component parts to an answer.
It is.
Because every business is a little different. I guess I would start by saying there are some basic disciplines that every business needs to have to manage its financial health. And the thing that we do a little differently in terms of how we're aligning with these organizations is we're not independent, if you will, offering arm's length support. While we're not taking on fiduciary responsibility, we're working directly with the business owners and with their staff to make sure that they're keeping their financial house in order. What's that ultimately mean? It comes down to, are you accurately reporting and recording the historical work that you've done inside your organization? And do you have an eye towards the future? And can you see where you're headed and what your financial needs are going to be? I really think it summarizes down to those two things. If anything gets skipped most of the time, it's that forward-looking piece. Any business owner who's ever said, I got surprised, I am not going to be able to make a payroll, they don't have their forward-looking house in order, right? They're in a place where they need some additional focus and attention, is I guess the way I'd say it. Every one of the service providers that's participating today, particularly those that are in the banking realm, have seen client financials that they've looked at and said, I don't think there's anywhere close to accurate. That's a great opportunity to call CFO Selections and get some help in getting those things refined and getting their house in order. So,
well, that's, you make a really good point about forward looking. Shirish, I'm guessing that you're asking manufacturers to be forward looking, especially with your services.
Absolutely. We are, our focus is, as I said earlier in my opening remarks, is revitalization of US manufacturing. We have amazing companies in our country, but manufacturing is going through a huge transition globally. And with focus on advanced manufacturing, automation, robotics, sensors, new materials, there is vast tectonic shifts that manufacturing industry is going to see. And we want to make sure that US stays competitive as this is happening. In the survey that was done by the National Advanced Manufacturing Institute, 70% of SMEs not only did not have plans for advanced manufacturing, they wouldn't even know where to get started. And in something that is going to hit us so strong, we want to make sure that our manufacturing companies are prepared. And our approach to doing that is partnering and acquiring the right companies where we see that we can create value. If we look at the company and we can't bring unique technology to create dramatic value in the company, then we don't want to put our 50, 100, 150, 200 million at risk. But those companies where we can create that unique value by either transforming the product and converting the product into a digital platform, for example, or looking at the processes, manufacturing processes of the company, and bring in technology around automation and robotics and other things to really improve the throughput and the efficiency of the company, or achieve margin expansion, achieve EBITDA expansion. But at the end, our focus is making these companies sustainable for next 20, 30, 50 years. And so we are not looking for, I believe the days of, still needed, but the days of creating value through Lean and Six Sigma, those days are over. What American manufacturing now needs is dramatic shift. I can give you example. However, Lean and Six Sigma, automotive company in Detroit may do, they can't compete with Tesla. They need to do a dramatic shift of themselves. Otherwise, we will see more and more where new entrants and new technology will continue to disrupt our traditional manufacturing base.
Shirish, could I ask you a question? I've been looking at the China's plan for manufacturing. They have a very aggressive plan as an example of somebody who may be coming to eat our lunch. Another very good reason for what you're talking about.
Absolutely. And you know, I live in Washington, D.C., and depending on who you talk, there is a lot of China bashing that occurs. And I take a different view. Every country has to think for themselves, and you can only respect other countries for wanting to be innovative and resourceful. What we need to do in our country is outsmart, outcompete, out-innovate other countries. We won't be able to stop them from doing, yeah, we can stop them if somebody is taking undue advantage of us or gaining access to our IP without our knowledge. Absolutely. But if somebody is becoming more innovative and becoming more advanced, more power to them. We need to leapfrog. We need to train our workforce. We need to invest in our manufacturing. The days of using our manufacturing base as an asset to be extracted from,
right?
I think those days are over. It's time we start to invest in our people, and we start to invest in the technology in our companies. And that's really what is at the core of Amg Partners. Companies we acquire, we want to acquire companies where this thesis creates tremendous value, and where the company and employees can really leapfrog to the next technology platform.
I think your words are very inspiring, and I think that other countries, what I'm hearing from some of our Industry 4.0 partners that we work with at camps, is that other countries are embracing the digital technologies faster than the U.S. So it seems like what I'm hearing is here in the U.S., we have things that work well, so we don't often think about what's next. And what Kevin was talking about, being forward-looking, and your comment about the survey from NAM is the idea that we need to really start looking ahead at what talents, capabilities, investments need to be made in the next to help us compete and outcompete. And I really like that challenge here in the next decade or 2 decades. So I like that type of forward thinking.
Other thing I would add is we are at a unique time, especially after COVID, that manufacturing is looking at coming back to US. More and more manufacturing is looking to come onshore. If you recall, we already had labor shortages before COVID.
Yes.
And to really enable this manufacturing coming back, the only way we would do this is being more technology enabled in our shop floors and our factories.
Investment in technology has proven to be, I think, the differentiator. And so our camps community, just in case those of you who may not have heard, but we have an innovation committee that is looking at all of these innovations and technology trends and new things coming around the corner. So we're trying to bring that to our manufacturing community. And, in some conversations, and I'm going to kind of go back to Joe a little bit here on this. I talk about how to leverage bank financing to increase the value of the company. And Shirish, and that was something that you talked about. But Joe, what is your advice to manufacturers on, taking a look at where they're at, but also where they're going, and how do we add value or increase the value of their companies through financing?
Well, I think that financing used appropriately can really help a company get to that next level. It can help them invest in that new line that will help them take on that new client, that will help them, take the company to the next level. I think one of the most important things is understanding the difference between income and cash flow. And I think that what I see in a lot of the companies that we do business with is that many times, especially with that company, maybe in that 10 to 20 million annual sales range, where they don't have a lot of depth necessarily in their accounting team, and where Kevin's team can really help is to be able to say, we've got an opportunity to take on a new client and we're going to grow 20% next year. Then the question becomes, how are we going to pay for that? Because to grow 20% next year is really going to take a lot of cash flow on the front end to invest in the raw materials, to invest in some additional employees. What's the CapEx that's going to be needed to be able to support this new opportunity? And a lot of business owners don't necessarily, that's not their skill set. They know how to solve the problem that the client's coming to them asking, can you manufacture this? But how am I going to pay for it? And how can I go to the bank and show them that if we implement this new line, if we take on this new customer, here's why I need this higher line of credit, and here's how I'll be able to repay it. That's really important to be able to put that onto paper in unemotional, non-anecdotal facts and figures to show how it will repay itself. So Kevin might be able to expand on that aspect, because we have used Kevin's company and recommended them to other clients who at their current size are doing just fine and they've got a good accounting team. But when they need someone to help them pencil out the pro forma, that's really hard, and it takes a different skill set sometimes.
Yep.
Well, that's a good point. Kevin, any?
No, I'm happy to embellish. We'll dive in willingly anytime a client needs help figuring out how to take that next step. It often is. It's a paradigm shifter for them. It's interesting. One of the things Kirk and I were talking about in the past is the concept that CFOs hammer away on a lot, which is cash is king. It really reinforces the point that you were making, Joe, about the difference between recorded net income and what your cash requirements are in order to scale and fund growth. They are absolutely not the same thing. And you need a very distinct approach to evaluating which is which. You can be a very profitable company and run out of money along the way. It happens to very large organizations in a great number of circumstances. So it can easily happen in a smaller setting. The other point I would emphasize is just as a regular practice, if you can be forecasting where you're headed, you're in better shot to start thinking about when you're going to expand those things. You already have the framework and infrastructure in place. Yeah. Lots of times the way we engage with clients is in an ongoing relationship, but we do a fair amount of project work as well. And some of those are absolutely, let me help you put a forecast together that once the framework is built, you as the organization can then use it to update it and manage things that are coming down the pike for you. And we move into the background until you need us again. So we can come at it from a variety of different approaches to get you the tools you need to manage the organization yourself.
Wow, that's great. I wanted to ask Nabil real quick, because you fit in a very particular way, and I want to call it creative financing, but in your world, cash isn't necessarily king, although it helps, right?
Well, yeah, so it's a great question. Thank you, Kirk. So as Joe mentioned, banks are cash flow lenders and collateral lenders are second, right? We're these flip, right? We are a collateral lender. We're going to look for collateral as our primary source of repayment, particularly collateral like, revolving collateral, like accounts receivable and inventory for a line of credit. So that's where we'll look first with respect to a line. Now, where we start looking at cash is when we do a term loan. So when we do a term loan based on secured by the equipment and machinery, of course, a manufacturing company doesn't want us to liquidate the machinery they depend on for their cash flow unless they know, this is the end, right? So in those cases, of course, we're just trying to make sure that the company does have sufficient cash flow to be able to repay us. But we don't do so in a formulaic basis. We're not a regulated lender. We're not using FDIC insured deposits in order to fund our loans, right? So, we're going to make loans that make sense, of course. And, if I can embellish a little bit more, why is it that we can do something that the banks can't in the lines of credit situation? The difference is our level of monitoring the collateral level, right? When we're relying on a true borrowing base, right? We don't do factoring, we don't do lock boxes and all of that. So we're truly underwriting based on the performance of the collateral of our client. What we're doing there is we're actually monitoring the level of their AR, and if we're lending against inventory, the level of their inventory every time they borrow against the line, or at least weekly. So banks are just not set up to monitor collateral on a weekly basis. It's just not in the business model. It would be too expensive. And frankly, they provide a whole host of other banking services that every company needs, right? But that level of monitoring is just outside their mandate, and it should be. And I've had this conversation, unfortunately, many times with many owners who don't understand why is the bank kicking me out? I don't understand it. And I have to come to the defense of the bank actually and explain why they just can't do that. But you know, we're set up to do it. We're a temporary lender. Our team in LA, that's all they do, right? They're servicing and monitoring the collateral levels of the company so that we can, and we're monitoring that as our primary source of repayment. So that's how we're different.
Yeah, I'd like to kind of go on a different line of questioning. If I can start with Shirish, I'd like to just kind of ask from your experience, what is that initial conversation like with your company, with you and your company?
It really starts with, first is just introduction to the business. What is the business? What does it do? What customers, what markets, what products? But from there, it then gets into what are the objectives of the business owner? If their objective is, look, I don't care about my business. I don't care about my employees. I want to get rid of my business. That's not the right kind of business partner for us. It's really somebody who says, look, we have this amazing customer base. We have these products. We have the technology. And really, it's a process of discovery, Kirk. It's really understanding what the challenges and opportunities of the business are. And if we realize that the challenges of the business are, look, my salespeople are getting upset because we are booking so much business, but we can't keep that production going. Or our challenge is that we have great top line, but our cost of manufacturing is very high. Or our customers are demanding more innovation in our products, but we are not able to offer them. So once we understand the opportunity or challenge, it really then goes into us doing our own thinking and saying, how do we address the challenges or some of the issues that the business owner is bringing up? And sometimes, you know, we've been around the block enough. Just by walking through a plant, we can see those opportunities. We can see where there is opportunity to bring new technology. Looking at the products of the company, we can see where the markets are growing or going, and where we can really convert a product which is an electromechanical product, but convert it into a digital platform. Maybe the company is making certain kind of sensors, and we can take the sensors into the next level of digitization. The company is using a lot of manual labor to produce something, and we can bring more advanced technology, more precision manufacturing capabilities to produce to change the production system. But it starts with understanding that other thing we also look for is the character of the business owner and the character of the company. Do they care about the employees? Because employees will have to transition a lot. We look at a company that is doing 500 million welding by hands, and we would be transitioning that welding by hands into robotic welding with robots doing the work. That is a huge transformation for the employees of the company. And if the culture has been such that people are resistant to change, then we may come up with the best technology ideas to invest in the company we acquire. But if that is met with resistance every step of the way, that is also not ideal for us.
You know, you bring up such a good point that you're investing in the culture as well as the strategy of the company. And I think that's wise. And thank you for kind of walking us through what it was like for a new customer to talk to you. And that's very insightful. And actually, it sounds so reasonable. And so I really appreciate that. And Kevin, I wanted to ask you the same question. A new client comes to you. Where do you start?
You know, it really varies. I appreciate that question a lot. In lots of cases, and I'll say this as unfortunately, it's a pain point that starts the conversation. There's an immediate need that needs to be addressed in lots of cases with us. I've lost someone, so there's an interim gap that needs to be filled. Or one of the related commercial bankers has said to them, your financials aren't up to snuff. You need help getting those corrected. Or that one I mentioned earlier, I got surprised and couldn't make a payroll. How can that happen? I need things to be resolved. Any one of those could be a starting point. Conversely, there's also some very proactive situations that we're asked to come in and help participate in. Anytime you'd have a conversation with somebody like Shirish, he wants to see a professionally managed organization with financials that clearly represent the status of the firm and a pretty clear idea that management knows where the business is going. Getting a package together to have that, excuse me, kind of proactive discussion with a third-party organization that is looking to invest in you is really, really important. That's also something we can help with. So any number of those things might be an entry point with us. Beyond that, once we get those things, one of the things we do organizationally is really take a hard look at who is it as a resource on our team that is going to be the best resource to help this particular organization. I mentioned we have 85 CFOs, and the simple fact is all CFOs are not created equal. As much as I like to say to everyone, a debit's a debit everywhere we go, and we speak the same language in every business. The simple fact is how those debits are applied in organizations can differ widely. The fund accounting principles that exist in nonprofits are not the same as the cost accounting principles that exist in every manufacturer. And you need someone with a depth of experience that can speak that language and apply it correctly. It's going to have really significant implications when you're trying to forecast where an organization is heading. So all of those things are factors that are in play when we're starting a conversation with an organization we've never worked with. Thanks again. Great question, Kirk. Appreciate it.
I really appreciate that. And I hope everybody's kind of getting the feeling that these are very easy people to talk to. And if you're feeling like there's some dirty laundry, I think they've seen dirty laundry before. So it's you know, you don't have to exercise before you go to the gym or get your financials straightened out before you talk to these people. They can take you where you're at. Nabil, what's it like when you have that first conversation with a customer?
Well, that's great. It sort of depends. We get most of our clients actually from referrals. So from great people like Kevin and his partners at CPO Selections. When we get referred into a client by by a financial intermediary or a banker that already knows our model, then that's great because they've gotten a little bit of a upfront education on what an asset-based lender is and how we're different from a bank. But if even in those cases, I usually do have to spend some time with the owner explaining how asset-based lending works. Also the landscape of different kinds of lenders out there, because I used to be, how I got into this world of alternative lending is I actually started my own finance company, a factoring company. And, I got a master's education in alternative lending when I tried to own my own company and lend my own money, as you can probably imagine. But so as a result, I actually, when I was an entrepreneur trying to lend money, I had made it my mission, frankly, to really understand the whole landscape of alternative lending. Because in case, most clients, frankly, particularly in the Seattle area, tried to avoid factoring at all costs. So I would refer relationships to asset-based lenders and other kinds of lenders out there. Well, after a couple of years of trying to lend my own capital at fairly high rates in terms that most owners don't want, I ended up, if you can't beat them, join them. So an opportunity came for me to join Celtic Capital. So I do spend quite a bit of time educating clients about different kinds of alternative lending, what we do, and how we're different from banks. I mean, obviously, as we mentioned, we're going to monitor the collateral at a much closer level, which requires their staff to give a lot more reporting to us about their new sales and or receivables than they're accustomed to when they were in a bank relationship. We also do typically more exams, more audits. We do personally, our company does 3 collateral exams a year. It's slightly different than bank audits, because banks, again, are cash flow lenders and they're focusing on the accuracy of their cash flow reporting and their cash, whereas we're focused a little bit more on the collateral, right? And the accuracy of their reporting on their collateral level. So anyway, I explain those things and educate, make sure they're comfortable and understand the differences. And hopefully, you know, if they give us a financial package and we've got a proposal, we spend quite a bit of time explaining the proposal and all the terms and making sure they understand what they're getting into.
Again, a very friendly process, which I really like. Joe, what's it like when you first meet with a new customer?
So do you mean a new prospect? Someone I don't know?
Prospective client, yeah.
Yeah. I would say as much as anything, COVID has been hard because one of the best ways to learn about the company is to actually meet with the client on their premises to be able to see what goes on at their facility. But what I like to do is just really understand, what does the company do? How do they make money? How does their entire cash flow cycle work? From the time that they get a deposit to how long is your manufacturing process? When do you deliver? And then how quickly do you collect? Just to be able to understand at a high level what that cycle looks like, the cash conversion cycle. I also like to get to know the management so that I understand who all of the players are, not just the controller or the CFO, but what role is the CEO playing in all of this and in the strategy? And is this a family-owned business where you have the family dynamic that you might not, as a banker coming in, getting to know the company, you may not see the impact of the family until you get into it. So kind of understanding just who are the decision makers and how do those dynamics play in to the controller, CFO, that generally the banker's talking to on a regular basis.
No, that's very excellent. Once again, I was hoping to create a level of comfort in those initial conversations to have the people who are here today and also watching. And I know that some of the people who are here will refer business to those who are speaking. And I think there's been a lot of wonderful insight today. And Joe, thank you for that.
Yeah. Hey, Kirk, could I throw one more thing out there that I think for all the business owners that are on the call, when you're talking to your banker, I think that it's helpful with whomever you're dealing with to be able to feel so that the banker does feel like you're in control of your business. And when I'm looking at that annual line coming up for renewal, I think that's a good time to talk to the banker about what you see as your need going forward for the next year. Not just in the line of credit, but maybe to proactively share with them what your plan is in terms of top line revenue and how you think the net income is going to look if all these things come into play. That also helps me to anticipate, do I need to set up an equipment line for this company? Do I need to look at raising your line of credit proactively to support you in what's going on? So just to all those companies that are out there, having those regular conversations and check-ins with your banker is going to make it much easier for them to do a quick turnaround when you say, whoa, didn't expect this, but I just got a new piece of business and now we need to expand the line, or now we need a new CNC machine. If that banker is aware and you've been having those conversations, it's going to be a much easier conversation to ask for that extra funding.
Well, that's a really good point. I think regular communication and talking about the future. I think looking ahead at what you need. These are all very important parts of business success. And so we're coming down to our last few minutes, and I don't know if there is any other questions from the group, but so you can pop in a question if you'd like to. But I'd like some just last minute advice from each of our panelists. Shirish, if you had some last minute advice, to help the manufacturers continue to be more successful, any insights or advice?
Yeah, my biggest message to the manufacturers would be really all about looking ahead, thinking where the manufacturing world is going, and really looking at innovation, both innovation on the product side, innovation on the shop floor, and using those as a driver of value creation going forward.
I love your term value creation, and that was great advice. Thank you. Kevin, advice for us?
Yeah, I think, you know, we talked a lot about being forward looking in your business and having the ability to look out into the future. I would add to that, be in a place where that can be a variable forecast and accommodate a variety of circumstances. If this last year taught us anything, it's that stuff happens and you can't see it coming, and you've got to be in a position where you can react and understand how those things are going to impact your business. And for several organizations last year, that was a week-to-week and sometimes day-to-day evolution that companies were trying to get their arms around. I mean, think about it if you were in the restaurant industry, for Christ's sake. I mean, no way you knew what was going to happen. And there was nothing those folks did that caused any of this, but they had to react to it. Be mindful of not just the forward-looking, but the fact that it needs to accommodate a variety of outcomes. And yep, that's something we can help you with. So
perfect. That's great advice. Thank you. Nabil?
Yeah, well, I'm going to actually obviously echo the advice given about seeing the future, but you know, most of the clients I speak with, or prospective clients, they have just gone through some of the most unprecedented period. And so my advice is to actually take a moment, take a breath, have some grace, and you know, forgive yourselves for not knowing everything. Because frankly, what we've asked, if you're a manufacturer and operate a facility with employees, we're now asking all these owners to be public health experts. We're asking them to be environmental experts. How do I make sure I have a safe workplace? And we expect them to have all the answers. And honestly, you know, that's a lot to ask. And I know when I've spoken to many owners, this last year has felt like dog years. And so, you know, you're entitled to obviously also take care of yourself. So my advice is take care of yourself, your own mental health, and whatever it is that make sure that you're physically and mentally ready for the future, which frankly, who knows? I mean, the world is uncertain. If the world has taught us anything, that we need to all be resilient and adaptable, and lean on others. Ask for advice when you don't know.
Thank you, Nabil. And in fact, all the people on the panel here today are good people to lean on. And that was great advice. Thank you. And thank you for your personal touch on that. Thank you. That's very nice. Joe, what advice do you have for us?
I would say for all those owners out there, your banker really does care about you. Your banker wants to hear how things are going, both good and bad. Your banker hopes that you'll pick up the phone and call them when you win that big deal, as well as when that customer that maybe made up 5 or 10% of your total revenue tells you that they're going to go somewhere else. We really do care, and we want to kind of help you work through that. And we want you to feel like having those easy conversations. Then when something big comes up, it isn't hard to pick up the phone and call the banker and say, wow, you're not going to believe what just happened, or wow, you're not going to believe what just happened. We do want to be involved to the extent that you'll let us.
Yeah, that's plus, you know, bankers see a lot of things, and they know a lot of things. They know a lot of people. So in terms of connections and insight, your banker is a great resource for connections and ideas and resources. So I highly advise.
We may very well have had another client who's been through something very similar. And so you're saying, oh my gosh, this thing just happened. What in the world am I going to do? And your banker may say, you know, I had another client that went through this, and here's a good idea of how you might solve it.
I agree with that. Yeah, talk to your banker. It's a really good idea. Well, I want to thank all of you for being here today. I want to thank our panelists.